Hi, this is Dan Passarelli. Sorry, my microphone is muted. I want to make sure that everyone can hear me. If you can, please go down to where it says questions and type in whether or not you currently trade options. So just a simple yes or a Y if you trade options, or a no or an N if you do not currently trade options. I got some response, so I know people can hear me. You guys must have been working so hard listening to all these presenters that you're exhausted and you don't feel like even typing anything. Is that what's going on here? Well, you guys better wake up. We've got an exciting presentation, and looks like actually about 50-50 of you trade options. Okay, that's great. That is really, really great. Well, here's what's up with today's presentation. We are going to cover some option trading concepts. And for those of you who said, yes, I trade options, this is going to be a great presentation for you because we're going to build on all the things you know already, and you're going to learn a whole bunch of stuff that you don't already know. But for those of you who said, no, I don't trade options yet, this is a great presentation for you too, because you know why? We're going to kind of start at some of the basics, and you're going to leave this presentation learning a whole bunch of really great stuff. Now, before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. You can get a copy of that by calling 1-888-OPTIONS. All right, so here's what I'm going to reveal today: how to generate consistent, predictable income. We're going to talk about the 3 analyses you need to set up winning income trades and how to avoid common income trading traps. Now, some of these terms like income trading and such will be defined in the presentation, so don't worry about that. All right, now first, I want to talk about something basic here. And this is, I've got a lot in this presentation that's intended to be very liberating, to sort of make trading feel less daunting. And the first is, I want to tell you that everyone makes mistakes. And you can see very clearly in this picture that I've had my fair share of mistakes as well. This is a picture of me down on the Chicago Board Options Exchange trading floor, circa 1998. And I don't show this picture to a lot of people. If you tell people about this picture, I will deny it vehemently that that's me. I'll say that was a stunt double photoshopped into this picture, because that haircut was a terrible, terrible mistake. And I make mistakes in my trading just like you do, just like everybody else does. And I still make mistakes in my trading, even after having a pretty darn long career in this business. This is me, you know, in some of the financial media, which I'm on, you know, I mean, somewhat regularly, I guess. And every time I'm on, they ask me for some sort of a trade idea, you know, to talk about a trade that I'm looking at or something like that. And, you know, a lot of the times the trades end up working out great, but sometimes there I am on national, or I guess global television, and, you know, the trade I talk about ends up being a total lemon. So it still happens, but you know what? That's not really the end of the world, because as I'm going to show you in a second, good trading doesn't necessarily require you to be correct every single time. And to be sure, I will tell you that option trading is not about predicting the underlying stock price. Option trading is about using quantifiable statistical measures to predict potential profits and to optimize risk reward. It's much more of a numbers game than a skilled guessing game. You know, we're trading not like gamblers, but more like the casino is the analogy I use all the time. Now we're going to talk about some of these strategies, some strategies that can give you a very, very high probability of success. These strategies can work in any market. I was giving a presentation just like this, oh, I don't know, maybe a couple of months ago, I guess it was, a month or two ago. And somebody says, well, do these strategies work on ETFs? Yes, you can use these strategies on ETFs. You can use them on stock options. You can use them on currency options. You can use them on futures options. You can even use them on Chinese options. This is me here on the, I guess that's your left. This is John, our head coach. He teaches our group coaching class, which is a daily class where he gives trade ideas every day. He's a former Goldman Sachs guy. And a couple other people who were invited, a couple other options professionals who were invited by the Chinese government to come out and teach classes to leaders of exchanges and brokerage firms in China as they roll out their new options market. So we were pretty honored to be invited there, but guess what? The same strategies that we talked to them about are the exact same strategies we're telling you about. So, you know, this is kind of proof positive. These strategies are valid in any market. So what we're looking to do is take from the market, not get taken by it, right? I found this to be a pretty useful and telling quote that I came across not too long ago by Warren Buffett. I will tell you how to become rich, close the doors, be fearful when others are greedy, be greedy when others are fearful. Now, in a lot of ways, that's the opposite of a lot of trading that probably a lot of you guys have done. I think there's a lot of trading methodologies where what you do is you look for a trend that's established and you pile on. You know, you jump on and do what everybody else is doing. Oh, the market's been going up because people have been buying it. Well, okay, I guess now I'll buy it too. And you hope that the trend continues. And don't get me wrong, you know, obviously that can work. You know, I know a lot of successful breakout momentum traders, but sometimes it doesn't work, as I think we've all gotten a pretty good dose of how and why that sometimes doesn't work out for people just recently. So this is a different type of philosophy of trading that you can still use even if you are a momentum trader or breakout trader. It's sort of another tool in your toolbox so that when the momentum and breakout trades aren't working so well, or when you come across a stock that's maybe stagnant or trading in a channel or is just, you know, has low volatility, these are strategies that can work in those scenarios. So what this does effectively is it broadens your possibilities for profit. It gives you many more scenarios that you can profit from. All right. So the specific option strategies we're going to talk about today are called income trades. Income trades are a family of option strategies that benefit from time passing. We're profiting from the phenomenon of time decay. Now, about half of you guys said, yeah, I've never traded options before. Does anybody need a crash course in what an option is? Everybody know what calls and puts are? Just conceptually, even though you may not have traded them? I'm getting a lot of yeses. Okay, good. Well, that's great. So we can kind of hit the ground running. There are two types of credit spreads here that we're going to talk about today. The first is a call credit spread. The second is a put credit spread. Now, Again, this is predicated on the idea that as time passes, options lose value. Now, yes, if I buy a call and the stock goes up, I can make money on direction. So I've got direction working for me, but I still have time working against me. The more time that passes, even if the stock does go up, you know, I've still got this sort of drag on my profitability as time passes because of time decay. So this is a way that you can actually turn that around and put it in your favor and profit from time decay. These are option selling strategies, but option selling strategies with protection. So a credit call or a call credit spread is when I sell a call that is out of the money, and that's my trade. I'm hoping to profit from that call becoming worth less. You know, it's a short position. But I'm also buying a higher strike call that costs less as an insurance policy to limit my risk. And the same idea with a put credit spread. I'm selling an out of the money puts, and that's my trade. I want that put to become worth less, but then I buy a lower strike put that's farther out of the money that costs less as an insurance policy. So conceptually pretty simple, and I'll kind of show you how this works. These prices are not current. This is a trade that we actually talked about in our group coaching class the other day. In the group coaching class, we were talking about John Kmisik, actually, the guy from the picture that we were in China with, former Goldman Sachs guy. He was talking about MBLY. And MBLY had established support. All right, there's support at about what, 45. Okay, and so what John looked at was selling the 45.5 puts, and at the same time buying the 43.5 puts. Now, what kind of trade is this? What is the name of this spread? Who can tell me what the name of this spread is? If I sell the 45.5 puts and buy the 43.5 puts, what kind of spread is that? Is it a time spread? Is it a butterfly? Is it, yes, that's right. It is a put credit spread, right? Because I'm selling a put that's out of the money and then buying a lower strike put for protection. So the idea of this is simple. MBLY was at 47.38 when John talked about this trade. And there was support at about 45. And so as long as MBLY didn't fall below 45.5, the trade was a winner. So this actually is kind of, well, it's a high probability trade. And it's kind of a liberating trade, isn't it? Like, you look at this and you think, huh, well, as long as the stock doesn't go down too much, I make money. So the stock can go up, I make money. The stock can stay where it is or stay in a range, I make money. The stock can go down almost $2 and I make money. So the permutations of events that can happen in order to still make money are huge. Because if you think about it, like the way a professor would think about this is there's about a 50-50 chance of a stock going up or down, right? Now, do you believe that? Probably not. Do I believe that? Probably. Well, no, I don't believe that. I don't believe anybody can predict the future, but I believe that some people can have reasonably good estimations and be better than 50-50 at guessing if a stock's going to go up or not. But let's just say that there's never been a person born into this world who could predict a stock price any better than 50-50. you know, I don't think that's realistic, but let's just go with that assumption. That's what a pure mathematician would assume. So then if there's a 50-50 chance of it going up or down, then if it goes up 50% of the time, I make money 50% of the time. But the other 50% of the time when it goes down, some of that time I make money too. So the odds are better than 50-50. The odds are in my favor. And in a few minutes, I'm going to show you exactly how to measure those odds. So what we did here is we set up a high probability trade that mathematically and logically has the odds in your favor of winning, and not because we're great at predicting, but because we put on a smart strategy that has forgiveness, that gives us wiggle room if we're wrong. So when John talked about this spread, he talked about selling it at 30 cents. So the most a trader putting this, you know, if one of our students in the class put this trade on and sold the spread for 30 cents, they could have made 30 cents. That's $30 of actual money, right? And your chances of making that were really great. The max gain is your credit received. Now the max loss is the difference between the high strike and the low strike minus the credit received. So 45.5 minus 43.5 minus $1.70, or excuse me, minus 30 cents is $1.70. All right, so that's a put credit spread. That's how it works. That's kind of a crash course, like real trade from the real market, you know, like a month or two ago. Now, let's talk about how did John find this trade? Well, I mean, first of all, he's been doing this for a million years. He's been in the options business for like 25 years, 27 years, something like that. He's sitting right behind me. He doesn't even remember. Well over 25 years. But the truth is, it's actually pretty easy to find these trades when you know what you're looking for. There's really two things you have to concentrate on. One is analyzing the underlying stock or ETF or whatever, and the other is volatility. We want to find a stock that has hit support or resistance and bounced off, and we're going to use that to set our short strike prices. And then we're going to find one that has volatility elevated. Now that one's a little bit of a tricky one. I'm going to focus on that second bullet point in a second here. First, I told you, I promised you that I would show you how to exactly measure the probability of success. Now, this is about as exact as you can get. It's actually a little bit of an estimation. I call this the trader's definition of delta. Delta is thought of, it's not mathematically exact, but it's thought of as the probability of an option expiring in the money. So imagine an out of the money option, call or put, has a delta of 25. Well, actually, this one does have a delta of 25. This is a put, in this case, has a delta of 25. So by this definition, that means there's a 25% chance of this put expiring in the money. Now remember, if it expires out of the money, that's good. Stock goes up, stock stays where it is, stock goes down a little, good. As long as this put, both these puts expire out of the money, I get to keep that 30 cents. So hold on a second. There's only a 25% chance of expiring in the money, so that means there's a 75% chance of expiring out of the money. So that means there's a 75% chance of this trade hitting its maximum profit. And the chances are technically even a little bit higher, because this is assuming, you know, this is the measurement of the likelihood of the option being in the money at expiration. It could technically fall a little bit below it and then come back, and as long as it's still out of the money at expiration, even if it was in the money at some point, it's still a winner. So your chances of making money on this are entirely measurable. All you have to do is look at the delta. All right, So let's look at our trade again. Before I was saying, well, you know, we don't want the stock to fall below 50 or 45 and a half, but it's actually an extra 30 cents because of the 30 cents I collected. The break-even point is 45.20. There's a 75% chance of it not falling below 45 and a half and hitting my maximum profit potential. Now, to be fair, what a lot of traders do is they close option positions before expiration once the risk reward is not favorable anymore, so they can stop tying up their margin and move on to a, you know, trade that has a better chance of making a better amount of money and put their margin money to better use. But all right, so the criteria here are, we're going to look at the chart. We're going to look at the fundamentals. Now, I didn't really talk about that much. Let's talk about that for a minute. What's the enemy of this trade? What's the enemy of selling a put spread? Who can tell me? I'm going to look at the attendee list. I'm going to call somebody out. How about Yvonne? Yvonne, what is the enemy of this trade? Well, it can't have too big of a move to the downside. Now, what if there's a big move to the upside? Well, it's fine. You're a winner, you make money, but you're limited. You only make 30 cents. So this is not a really great trade if you're like screaming bullishness. This is a trade for low volatility. So we want to avoid volatility events. Now, maybe you haven't heard people use the term volatility events before. It's a very option-centric sort of term. But, you know, when you think about it, there's a lot of volatility events that are telegraphed. They're reported by the news in advance. Earnings, right? Like, you know when earnings is, and you know that earnings is probably, you know, destined to give you the biggest move of the quarter, or one of the biggest moves of the quarter. So looking at earnings and not putting this trade on if earnings is coming, or at least have the expiration of the options before earnings comes out, is a best practice here for these trades. And then volatility. Now let's talk about volatility. Okay, so avoid earnings. On the one hand, that's volatility events, but I'm talking about something a little bit more specific here. I'm talking about using volatility charts. Okay. What we're looking for with volatility charts is we want implied volatility to be above historical volatility. Now, these are probably new terms. Everybody who said, hey, I don't trade options yet, these are probably new terms to a lot of you guys. Don't sweat it. Implied volatility is basically like the relative price of an option. When implied volatility goes up, the price of the option goes up. When implied volatility goes down, the price of the option goes down. And historical volatility is how much the underlying stock moves around. So you want the options to be expensive compared to how much the underlying stock moves around. Like, you want the underlying stock to not move much, so you want the historical volatility to be low, and you want to sell the options for as much as possible, so you want implied volatility to be high. And then you also want implied volatility to be in the top half of its 6-month range, so you want options to be expensive relative to themselves. Now, that's just basically a little bit of a crash course on volatility. But when you use volatility, here's what happens. You put all 3 sources of profit on your side. Because you're selling this position, as time passes, you will make money on time decay. Now, could you lose it on other things like direction or volatility? Yes. So we also have to pay attention to them. We can't just sell options and not even think about looking at a stock chart or anything. We want to look at a chart of the underlying. And if it's a put spread, we want there to be support below the market so that there's something that can potentially keep the market propped up, have it not fall below our short strike. If it's trending up, that's fine. If it's trending sideways, that's fine. We just want to see that support below the market. That's another thing that gives us an extra sort of edge. And then volatility. Because we're selling this, we only like to sell expensive things, right? If you own a store, do you want to, like, you know, buy your widgets at $5 and then sell them at $4.50? No. You want to sell whatever it is you're selling at a high price. And that's what volatility does for us. And when we focus on all three of these things, time, direction, and volatility, and put them all in our favor, this is how professional traders trade. This is how professional traders think about trading. They give themselves every advantage they can get because they know what they're really doing is they're managing uncertainty. All right, so how often can you find great income trades? 3 words: all the time, every day, every single day. I mean, that's what John does in our class. He finds income trades every day. They're out there. Now, some periods are better than others. Sometimes when the markets are moving really crazy, income trades are a little sketchier. Got to be a little bit more careful. Sometimes, like, you know, last week, when the volatility is very low, you know, the options aren't expensive enough to sell. But there's thousands and thousands of different stocks that have options listed on them, and ETFs too, and everything else. So if one stock's options don't look good for a credit spread, there's another one out there that does. As long as you follow the steps, looking for support, resistance, volatility, and avoid earnings, you put yourself into a really good situation. All right, so I put this slide in here to be a little bit motivating. All right, I've been in the options business myself for a lot of years. I started down the trading floor in 1993. And I know a lot of people who all they've ever done for a living is trade options. You can potentially make a lot of money trading options if you're good at it, if somebody shows you how to do it. And so, you know, it's enabled me to be able to do a lot of great things that I probably couldn't otherwise do. Like, you know, one of my hobbies is traveling, is me and my family at the Grand Canyon. Another one is playing in a band, and I like to spend money on guitars and such because it's fun. But, you know, without having had a good career as a trader, I mean, I probably wouldn't be able to do a lot of these things. So I say this all to motivate you. When you put your mind to it, and it doesn't take a lot, it just takes a little bit of commitment, but when you put your mind to it, you can potentially do these things as well. You know, whatever it is that floats your boat, whatever it is you like to do, your hobbies, you have that potential power. All right, so here's what we learned today: how to generate consistent, predictable income, the 3 analyses you need to set up winning trades, things to watch out for. We didn't cover everything there is to cover, like scanning or how to, you know, exactly which strikes or expirations to pick, you know, but we did cover a way to take from the market and not get taken by it. So I want to talk about this real quick. This is a simple process that I want to share with you. I think anyone can take money from the market consistently and with low risk. The problem is most people overcomplicate it. So we have a course, it's called the Income Master Sessions. It takes what we covered today, fills in all the gaps, talks about a whole bunch of other strategies also, like time spreads and iron condors and butterflies that you may have heard of. And it helps you so you can stop trading the, you know, bound to fail strategies where you're just kind of guessing, hey, I think the market's going to go up, I'll buy calls. This is putting the odds in your favor so you can generate consistent low risk income. The class is a full 6 hours long. And I'm going to show you, it's a video class. It's 6 hours long, covers all these things. And it's designed to take your trading to the next level, to avoid common mistakes of novice traders, and to maximize your profits and chances of success. This class is for traders who want more consistency, want more frequent winners, can follow a few simple steps, and believe your success is tied to a methodology. It's not a get-rich-quick scheme. It's not for people who can't make decisions, who are indecisive, get analysis paralysis. And it's not for somebody who's looking for the quick fix, the Band-Aid solution. All these videos are on demand. The Income Master sessions, it's 6 videos, they're all on demand. There is a live component that I'm going to tell you about in a second. You don't need any special software for it. It's good for ETFs and stocks and everything. And it's about, with the bonus, it's about 25 hours of class time. So the Income Master sessions is the class. The bonus is the group coaching class. So the Income Master sessions are all on demand. As soon as you enroll in this, you're going to get these videos right now. You get automatic access. It's all automated. The group coaching, you get to start the live class tomorrow. That guy I mentioned before, John Kamisik, the Goldman guy, former Goldman guy, he teaches this class every single day. Tomorrow morning at 10 a.m. Eastern time, that's 9 Central time, he's going to give you about 10 trade ideas. And you're also going to get access to the recordings of those past classes. Now, I've got a deal here today. When I do these presentations for, you know, the good people here at Investor Inspiration, what I like to do is I like to give a discount for their people. So you're going to get all 6 of these videos that I value them at $100. Truth be told, the information you get out of those videos is priceless. But you know, if I were to sell them individually, I'd sell them for $100. It is a $600 package. That's what I sell this for. But I'm also going to give you a free month of that group coaching class, that everyday live webinar at 10 a.m. Eastern, 9 Central, where John's going to give you trade ideas every day. And about half of you guys said, hey, look, I'm brand new to options. I'm going to give you the Options Impact video series, which we sell on our website for $497. I'm going to give that to you free today. So instead of this $1,400 package, today it's going to be $397, and I have to limit the number of people I accept, and I'll tell you why. So if you want to be one of the first, go to markettaker.com/take, markettaker.com/take right now. And for the first 2 people who sign up, I'm going to send you out one of my hard copy books, The Market Taker's Edge, published by McGraw-Hill, but you have to be one of the first 2 people to enroll right now. As soon as you do enroll by going to markettaker.com/take, here's the class that you're going to get instant access to. You're going to start watching these Income Master Session 6 videos right away, get an invite for tomorrow's class live, and we're going to take 20 people, up to 20 people. And people sometimes ask, well, hey, how come you have to limit it? You know, I mean, you can let as many people in the class as you want. We have to limit it because of the live component. Because the live class, there are a lot of people who sign up for the class just to trade the trade ideas of John, because, you know, he's great. And so because of that, if we had like 1,000 people in the class and, you know, everybody in the class trades at 10 lots, I mean, there's 10,000 contracts being traded. I mean, we'd move the market. So we have to keep the class small enough. Right now we've got, I don't know, close to 120 some people. So we are going to cut it off at 20 today. Go to markettaker.com/take. And if you were one of the first 2 people, if you think you're one of the first 2 people, just go down to where it says questions and, you know, say me or something and call my attention to it so that I know, and I'll make sure that I look for your name and make sure I send you out one of my books later today. Now, does anybody have any questions about this deal, or about the class we talked about today, about credit spreads. Is there any way I can help you before we part? I'm still yours for a few minutes, and I would be glad to do anything I can to have you leave this presentation feeling really good about trading and about trading options specifically. Does anybody have any questions about anything that I can help you with? Okay, what other spreads are covered in the class? So we talk a lot about credit spreads, time spreads, iron condors, that kind of thing. These are all income trades. John will also talk about some other types of trades that are not income trades, like debit spread. He trades a fair amount of debit spreads. You know, sometimes just simple buy a call or buy a put. You know, John basically looks at the market and he says, what's the best way to capitalize on this with my whole arsenal of option strategies? Mike says, do you trade any other strategies other than credit spread? Yeah, okay, so same question. Yeah, so like I said, yes, we definitely trade other strategies than credit spreads. You know, it's whatever the market's telling us. You know, like to me, that's the most powerful lesson you can learn as a trader, is to, instead of like getting great with one type of strategy, you know, if you're great with one type of strategy, that's great, especially when the market is conducive to that strategy. But when the market changes suddenly and violently, that strategy doesn't work anymore. Then you're out of luck. So what we teach our students to do is to read the market. Look, observe, and fit the strategy that best capitalizes on this market situation. Mike says, do you do straddle trades? How often do we do straddle trades, John? How often do you talk about straddle trades?
I talked to him a lot a couple of weeks ago, and something he was at his 52-week low.
Yeah, John, I don't know if you guys heard that. He's sitting right behind me. He said a couple weeks ago, when implied volatility was at its 52-week low, he talked a lot about buying straddles. Well, guess what? Anybody had those straddles on? I guess it worked out for him, didn't it? And you know, that's kind of a lesson in and of itself, just an option trading lesson right there. Whenever you're selling options like we talked about here, you want implied volatility to be high because they're expensive, and that gives you an edge. But when implied volatility is really low, like it was, you know, last week or whatever, then you're looking more towards option buying strategies. Again, you let the market tell you what to do. And when you do, trading gets a whole lot easier, because you're not fretting about trying to find something that fits your favorite strategy. You're just saying, okay, what do I see here? Okay, volatility is low. I could buy very, very inexpensive straddles. And, you know, obviously, hey man, if you're long a bunch of straddles yesterday, you creamed it, you did fantastic. So yeah, trading can be easy when you know what to look for. And that's what this class really is all about, is showing you exactly what to look for. Jamie says he has no sound. Oh, I think Jamie, everybody else has sound, I think, so. Right? Can everybody else hear me? Everybody else can hear me well, right? Sounds like everybody can hear me. All right, do we have any final questions before we go? I could probably give you guys another like 2 minutes. Again, you know, I've been doing this for 24 years. I've been in options. And, you know, I picked up things here and there. You know, if I can help you in any way, please let me know. I'm going to show you my email address in just a second. You guys can email me anytime. Obviously, the best way to, you know, follow us is to join this class, follow us every single day, and get trade ideas every single day by going to markettaker.com/take. Keith, you're welcome. You guys are all welcome. Once again, my name is Dan Passarelli. I'm from markettaker.com. You can email me, Dan@markettaker.com, and follow us on Twitter, twitter.com/market underscore taker.